Okay, welcome to Managerial Accounting, and this is Chapter 1. The PowerPoints I'm going through today is basically a subset of the full deck of PowerPoints that are accompanying the textbook, so there are more PowerPoints that you should read, but I'm just going to highlight a few of them today. So when you look at the manager's responsibility, it's all about planning, directing, and controlling. And this provides feedback for the management team, so that way it will help them in their decision making. So planning involves two main activities: setting the goals and objectives for the organization and then determining how to achieve them. So you might have a strategic goal, for example, of improving the quality of your ingredients in order to keep customers coming back. Or you might want to establish good relationships with the suppliers in order to get them to send you good ingredients. So the whole idea is to take those plans, translate them into budgets, and then try to determine if this makes financial sense. Directing, that involves overseeing the day-to-day or operations for the organization. So you could be looking at your sales data, for example, if you're running a restaurant, to see which menu items are generating the most sales. So, and then you'd use that information to determine which items you may want to drop, and then focus on some marketing strategies that would emphasize the popular menu items. So controlling, that involves evaluating the results of your operations against your plans and making adjustments as needed. So that would involve, for example, comparing your budgeted sales with the actual sales and then taking corrective action. You could be comparing your budgeted product cost against actual product cost. And again, if your costs are, say, higher than you had anticipated, then you may have to increase your selling price, or you may have to look for another supplier to provide your product cost at a lower price. The whole idea is to make sure your actual results are meeting your planned results. So decision making, management is continually making decisions while it's going through the planning, directing, and controlling of its operations. So if you're looking at a restaurant, for example, they might be considering the location of new restaurants, which restaurants to update and refurbish, looking at the prices of meals, looking at which menu items they should offer. So when you're looking at managerial accounting, comparing that to financial accounting, the whole point of managerial accounting is to provide management with information for them to make decisions regarding planning, directing, and controlling. You don't have to follow generally accepted accounting principles for managerial accounting. So the focus is on the future, helping them plan for the future, and providing relevant information for better decision making. So when you're looking at managerial accounting, it has the ability to provide segmented information rather than just a consolidated company-wide information. So, for example, you might want to break down the results of your operations by geographical area, by restaurant, by product line, etc. It can be any segment that's of meaning to the company in terms of making decisions. So we're going to switch gears slightly here. The next topic I want to review is ethical behavior. Ethical behavior is extremely important, well, for everybody really, but particularly for accountants. People are relying on the information that we provide them to make pretty serious decisions, investment decisions, and so on. So you need to demonstrate ethical behavior, so that means doing the right thing regardless of the consequences. So some example that you would identify as unethical behavior would be allowing the reimbursement of false expense reports, manipulating income. Sometimes people try to manipulate the company's income so that they can increase their bonuses if the bonus is tied to income. Employees performing tasks they're not qualified to perform, and that could have really drastic consequences if they're doing maintenance on equipment and that equipment failed and an employee was injured. And breaking confidentiality, providing information to another company or just to anybody really about confidential information from the company, that's a big no-no. So if you find yourself in a situation where you feel, there's unethical behavior going on, first thing you should do is see if the company has policies for reporting unethical behavior. And if so, follow the policy. If there isn't a policy for it, discuss the issue with your immediate supervisor, as long as they're not the one, involved in the unethical behavior. You can discuss it with an objective advisor. You can get direction from this local CPA, Chartered Professional Accounting Office. And I guess in a worst case scenario, you might want to speak to a lawyer about the situation. So it's important to recognize that not all unethical behavior is illegal, but all illegal behavior is definitely unethical. Another topic covered in this chapter is the issue of total quality management. So the goal here is to provide customers with superior products and services. You're wanting to continually set higher goals for quality, and there's actually an organization involved in quality standards. It's called International Organization for Standardization, ISO. So when you look at quality, there's various types of costs associated with obtaining good quality. So there's 4 major categories: prevention cost, appraisal cost, internal failure, and external failure costs. So I'm going to go through each of these in a little bit more detail. So prevention costs, the whole idea here is to prevent a quality issue from occurring in the first place. So that could involve training employees, evaluating your suppliers, making sure that they're giving you high quality inputs, doing preventative maintenance on your equipment. You could be redesigning your product or your processes. And second major category of cost of quality is appraisal cost. So this is basically inspection. So it's inspection of the materials, of the product while it's being made. So WIP means work in process, inspecting the final product, etc., and maybe taking a sample of products and testing them before they're actually put out to be sold. The third major cost of quality is internal failure cost. So this is when there's actually, the product is made, and after it's made, then you find out there's a quality issue. So that runs into quite a lot of cost, the cost of downtime on your equipment. You might have to rework the product, you might have to, just scrap it. You might have to dispose of the rejects or the cost of that. Machinery might break down, etc. So this all happens sort of after the product is being made. And then the most, costly category of cost is external failure costs. So this is after the product is sold. So at that point, the customer has the product, they might want to return it. You might have to provide warranty service, warranty on the product. You might have to send out a service rep to repair the item. Lost profit from the customers, and reputational harm, because if your products are of poor quality and word gets out about this, obviously you're going to end up losing customers. So your reputation is very important as well. So that concludes the main topics covered in Chapter 1.